You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com and co-hosts, Uncle Mike Tosaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionPit.com.
All right, everybody. That rockin' tune means it's time once again for the Option Block, everyone's favorite bi-weekly source for all things options related. A little bit of wit, a little bit of wisdom, a little bit of analysis, a little bit of unusual activity. Stir it all together with some strategery, some listener questions, and some peering into the future. And you have the toxic cocktail that is the Option Block. My name is Mark Longo, beaming to you from the worldwide options headquarters, capital, call it what you will, here of Chicago inside the Options Insider Studios. And of course, as always, you can always check out all of our previous episodes, 400 plus of this program if you got some time, and of course a lot more if you dig into the other dozen or so programs on the old network. You can always find those pretty much wherever you find this program, including the Insider Radio Network tab over there on the website or in iTunes or TuneIn or Stitcher, pretty much wherever you like to find your favorite podcast programs, including Downcast or Podcatcher or Pocket Cast, whichever one you like to use. And of course, that's too much work for you. Just grab our mobile app, available for iOS, Android, and the Fire OS. It's all baked into there, all of that goodness. You can build your own playlists, download, stream, even ask questions right from the app. So check it out. I think you're going to like what you find there. And hopefully you like what you find on this program, too, because we got a good team set up for the old all-star panel. Coming first from the land, the paradise on earth, known as scenic and lovely St. Charles, Illinois. We are joined by none other than Uncle Mike Tosaw from RCM Wealth Advisors. Uncle Mike, welcome back to the program, sir.
Always happy to come here from the tropical, yet winter, yet summer, yet whatever we care for, paradise of St. Charles.
All right, and that flurry of background noise means we must be joined by none other than the greasy meatball himself, Mr. Mark Sebastian, from many different spots, as well as, of course, from his moonlighting gig over there at OptionPit.com. Mr. Greasy Meatball, welcome back to the Option Block program, sir.
Yeah, good to be here. Good to be here. Great timing. I've got my cleaning ladies here in the office, so, shouldn't be any background noise at all.
I trump you. I actually have contractors in our studios here today. So
yeah, even better.
They're tearing down walls as we speak. I've got them to switch to hand tools instead of the automated version for the next hour.
Oh, that's very nice.
So hopefully we'll be spared the majority of the ripping and smashing that is going on here as we rebuild to better serve your needs, listeners. And speaking of serving your needs, it's time we got to it with the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody, welcome to the Trading Block. This is indeed the portion of the program where we break down what's moving, what's shaking, what's catching our eye in today's markets. We are recording this on Thursday, September 24th. For all of you out there playing along with the home version, which we don't sell, so you have to make it yourself, a little board game, a little digital version, whatever you prefer. And it was another down day on the street. Of course, nothing really to write home about from a net down movement perspective. Most of the major indices off ever so slightly on the day. The S&P selling off about 5 handles, the Dow about 70 handles, and the Russell off about 3.5 or so. And, of course, the good old VIX cash ticking up nearly a handle, hovering right around the 23 level, which brings us Yes, for all of you guys out there who are VIX lovers, and I know a lot of you VIX lovers also love your VIX statistics, historical data that makes it, let's see how many days now, 20 of the last 23 sessions above the 20 handle, which is indeed the longest stretch above 20 for those of you playing the home game in about 3 years, since June of 2012. So an extended stint above the 20 handle out there in VIX land. And before we dive into what we saw in today's market, I just want to kick things off. I spent most of the day, actually, didn't have a lot of time for watching the market today because I was knee deep in the other side of the market, which is the future side over there at the National Introducing Brokers Association Conference, the NIBA, which is about as sexy and exciting as it sounds, listeners. But actually, there were some interesting nuggets over there. And I always find it worthwhile for guys like us who spend the majority of our time in the equity and index options side of the space to take a glance every now and then up from our screens and look over at how the other half of the market lives, and getting knee deep into El Nino and livestock and all that fun stuff is always a fun and informative experience. A lot of cool takeaways. If you follow us on Twitter, we were tweeting from that conference. If you don't follow us at Options on Twitter, shame on you. A lot of good stuff coming over there. A lot of good nuggets out of that, like the fact that we are, of course, in the middle of probably the most intense El Nino, which is, of course, that warming in the tropical waters there since 1998. So that's a pretty substantial amount. And time period, certainly, if you follow the meteorological side of the space. And also some interesting new terms I hadn't encountered. You know, a lot of us here in the markets are very obsessed with cybersecurity. In fact, we spent a lot of time talking about that on our Trading Tech Talk program, a shameless plug. Check it out if you haven't listened to it, listeners. Well, in the ags world, they are fixated on another type of security, which is indeed biosecurity. It was a term I'm not really, wasn't that familiar with going into the conference today. And that is indeed not perhaps as you might sound. It's not bodyguards for pigs. No, it's actually something similar, though. It's people going in and out of these large farms and these agribusinesses and the details and what they have to do to keep those livestock safe from foreign pathogens, scrubbing down trucks, scrubbing down people, clean suits, all that crazy stuff you might see in a Michael Crichton, like Andromeda Strain kind of movie, coming to a lot of the farms to protect them from all these growing number of pathogens and foreign influenzas and bugs and things. So a lot of interesting topics if you don't delve into that side of the fence that often, and I know I don't get a chance to as often as I'd like. It was kind of interesting and informative stuff, and you can stay tuned to our site and to our Twitter and everywhere else. And we'll keep tweeting out developments from that one. Thought an interesting way to kick it off, because we don't really dive into things like biosecurity on a regular basis. And aside from that, well, Mr. Sebastian, I know you're not, we'll start with you. I know you're not really big on the ag futures side of the space, so a show like that, probably not for you. But what caught your eye in today's market, aside from biosecurity and livestock protection?
I mean, it was kind of a crazy day. At one point we were down 30, and then we basically got to unchanged in the day and ended up like nominally down. If you didn't know how ugly the market looked this morning, you would have thought that today was another boring day like yesterday, which actually was boring. But instead, the market was noticeably on edge ahead of Janet Yellen talking this afternoon. And apparently one of the big reasons we turned around was some JP Morgan quant said it's time to buy. I don't know why we care about what a JP Morgan quant has to say, but those are the two big drivers. A lot of short covering ahead of Yellen. The hope is, or the theory is, maybe she has her act together this time, because I don't think they were prepared for the last time they had a policy meeting where she talked. And maybe that could turn things around, because it was certainly a day where it looked like the volatility was pricing itself like the rails were about to fall off, and then the exact opposite happened. Everything turned around and we rallied big.
It's kind of funny you mentioned that, because I had a bit of that bifurcated view of the market today. I had a chance to check things going into the conference, and I was kind of out of communication for a lot of the conference, and checked it again when I was leaving, and I thought my quotes when I was leaving were actually were perhaps delayed or broken, because it didn't seem like we had rallied all that way back, and yet that's exactly what happened. So you're right. It was if you only had a chance to glimpse the market a few times today, which I was in that camp, it did seem like you were looking at a tale of two very, very different markets. We now turn our attention to the hinterlands of St. Charles. Uncle Mike, indeed a lot cooking, even though perhaps the end-of-day numbers don't reveal that. What caught your eye in today's activity, sir?
A couple things that not so much today's activity, but last night's activity. The fact that we gapped down 15 points in the S&P again going into the market today. It just continues with the theme lately of a lot of gapping within this marketplace. I agree with Mark in that it did look like the world was about to end and the rails were going to come off, whatever expression you want to use in the morning time. And I actually rolled down a couple puts in the morning time as well. But it was interesting from the standpoint that we did come back like we did. And I'm curious to see if we can continue this even after Yellen says her thing. The other thing that I noticed today was gold. We did have a nice little pop in the gold world today in the metals.
Yes.
So I think that's going to play a factor, and I'm curious to see how that reacts after Yellen speaks as well. So I'm going to be watching markets tonight, as I always do, but I think you may want to watch with a little bit more interest tonight, because we may get some more movement tonight, like we have been over the past few weeks, basically, in this new generation of overnight market movement.
I mean, Mike, gold was really interesting. You know, Andrew and I were looking at that this afternoon in the pit chat, and what we noticed was that the September 30 puts, so gold was up $2.30, and I could buy an at-the-money put for 70 cents. Sometimes volatility is just off. And, you know, I think Yellen is going to come out either super dovish and say, you know, here's what we're actually looking for. Like, she'll be decisive. Or she's going to say, you know what, we are going to raise rates on XYZ. And either way, I don't think she's going to allow this, you know, will they, won't they, volatility and uncertainty to continue. I have a hard time believing that she's going to let that happen, and so I'm just betting that I think this is just an off tangent. I would not be shocked if we came in tomorrow and by the afternoon, even if we aren't up huge, if the VIX is off significantly. You know, I was up substantially today and a lot more at one point, but I could certainly see a scenario where we break 20 tomorrow if she really phrases herself right. I've been saying they need to stop. You know, there's this 80s movie that, you know, I get a lot of knowledge from. And a wise man once named Mr. Miyagi once told a young boy named Daniel-san, a man who walks on the left of the side of the street is safe. A man who walks on the right side of the street is safe. A man who walks in the middle, eventually two cars come and whack. All right. And he gets squished. And that was what the Fed has been doing since that Fed meeting. They've been giving us, you know, a waffling, feckless, weak-willed, you know, uncertain, unsure analysis of the markets. And, you know, I don't think markets really care that much either way, which way we're going. And, you know, if they don't, you know, I think all we really need is a little certainty, and hopefully she's there to provide it this time.
Wow, that went a lot of interesting places. You had Daniel-san and Mr. Miyagi, Karate Kid, of course. You had Feckless, a word of the day word for you over there, throwing a lot over there into the greasy meatball stew.
Yeah, she
today.
just needs. I'm hoping she comes out and says, "Oh, I'm going to sweep the leg of market volatility."
That would be the trifecta indeed. I think you would fall off your chair and probably just die in a paroxysm of laughter and joy all at the same time.
If I'm ever a Fed governor, that's going to be my big thing. Sweep the leg.
If you're a Fed governor, then for our economy.
I'm going to put inflation in a body bag.
Good quality meatball as usual. But you're right. I was at most of this conference throughout the day, and even talking to a lot of economists who were there and things. Not usually the most animated of groups. Not usually out there to voice a lot of edgy opinions in talking to economists. And yet even they, some of them even said on some of their speeches today that Yellen has a bit of a credibility problem, which is a pretty big slam for an economist to say that about the Fed chairman. But you're kind of right. I can't imagine that she over there and the rest of the Fed, you know, they're supposed to be kind of this independent entity, supposed to be, you know, distanced from the, you know, the storm and the furor of the markets, and supposed to be kind kind of doing their own thing as an independent body. But yet you can't imagine that any of them see this outcome they've had right now as having been good, and what they've done recently as having been beneficial, and the way they wanted it to play out for the markets. This has kind of been a black eye for all involved, and I can't imagine they don't see it that way. And her remarks today, they were scheduled a long time ago. They're supposed to be about long-term inflation. But yeah, I wouldn't be surprised if he uses this opportunity to maybe stray a bit from the concept and the topic of long-term inflation to maybe hit on a few things that she feels maybe could tamp down some of this excess 23 days over 20 handle volatility we're seeing right now. And you're right. If she does that, then that would have that bit of Fed premium out there, whatever it is, and it certainly is measurable, whatever amount you think it is it 5 handles in the VIX cash? Is it more or less? Whatever it is, probably will be coming out, in which case we could be well south of the 20 handle even by tomorrow's open. Mr. Tosaw, do you expect anything interesting coming out of Miss Yellen today? You think we'll be coming off tomorrow if she puts markets at ease, if that's even possible for her at this point?
Well, I'm with you in your camp. I don't think this is the outcome with which they wanted. To tell you, we're going to raise rates at some point. I'd like to see it happen right now, to tell you the truth, and let's just take our medicine so that way we're not staring at the Fed and like you had said earlier, the will they, won't they volatility. I'd love to see them raise rates in the near term just because of the fact that I'm sick of wondering if they're going to raise rates or not. Will it be good for the market immediately? Probably not if you're a bull, but it's got to happen at some time. We need to get some type of normalization and process because otherwise the alternative is that we're just going to be, I think I heard the term today somewhere in the news, the Japanization of our economy, and that's not where we want to go.
Well, I agree with you there, Mike. The only issue that they've got is that, when they started to plan on raising rates, they were not counting on everybody else in the world devaluing their currency right as we're trying to revalue our currency. And I think that's really what's thrown them for a loop is that, they're talking about raising rates just as the Chinese are devaluing their currency. You've got the Europeans executing massive amounts of QE. They're doing it in Australia. You've got the Canadians doing it. Really, Japan for sure. Everybody in the world is killing their currency. And so I think one of the problems, and this is where they really do get their credibility problem, and where if they came out with some sort of realism, I mean, if you want to raise to a quarter, fine. A quarter point, fine. But what they really need to do is come out and say, we would love to take the U.S. economy is strong enough to take to raise rates. The issue is that everybody in the world is killing their currency, and we've got and that's basically tampering inflation. We're not in danger of deflation, but it's tampering inflation in the United States, and thus we're in a position where how strong do we want to make the U.S. dollar? If we want a strong dollar policy, that's one thing. It would be a totally changed approach to Fed policy over the last, 15 plus years. Since the Greenspan era, basically it's been they've had a soft dollar approach. So, they've got to figure out exactly what they want to do. I mean, again, I'm with you, Mike. I don't care. I don't care either way. I'd like them just to shut up and make a decision. And I think that the market would probably end up liking it, even if they raise. So that's kind of where I come from. And, I think the biggest concern, we've talked about the fact that there's a Fed premium. This is an organization that is at an ancillary level, at a minimum, responsible for fluidity and normalcy of financial markets, and they're the root cause of the lack of normalcy and fluidity in financial markets. It's completely counterintuitive of what they're supposed to be doing as the head of banking.
Yeah, it does kind of speak against their mission for trying to maintain some sort of a stability, and surrounded, like I said, by commodity guys and economists all day. And when you're surrounded by them all day, then it's just dollar, strong dollar. I heard naught but talk of that today. So yes, the dollar on the mind of a lot of people, particularly on that side of the fence as well. I'd be surprised if he touches on that today in her speech. But I do concur with you that regardless of what happens tonight, they should just probably shut up for a while. I think everyone's had their fill of the Fed for the foreseeable future, particularly when they keep doing this. They keep adding vol with no foreseeable reason, no foreseeable outcome. So, yeah, I definitely concur with the perhaps Miss Yellen should take a back seat for a little while, at least until they figure out what the heck they actually want to do. I do like your term before your word of the day, feckless. Maybe the feckless Fed could be a good title for us on the program today. We'll move on really quickly to some of the other things that are catching our eye from an options perspective today in the old markets. We talked on the last show about the Volkswagen story. It has evolved since then, of course. So this big scandal with the emissions, the stock taking a huge hit. CEO having stepped down. We talked a lot about how the bearish options were doing pretty well. I believe there were some out of the money, crazy out of the money, like €1 puts on the preferred shares. Talked about last time, making a 70x return. It's been a pretty good time to be a bear out there in Volkswagen. Well, now with talk of Porsche and all these other kind of CEO taking over and other things, it's just spreading. The suppliers are getting involved. It's spreading to a lot of other names, indeed to a lot of their big suppliers. So if you're looking for a little juice, a little vol out there in the auto industry, Volkswagen is supplying it these days in way of the ripple effect to a lot of other names out there, including a lot of names that work with them like Borg Warner, Cummins, Harman, and Tenneco, all hovering at or near 52-week highs from an implied vol perspective. So if you're looking for a little juice, Volkswagen is sending it in mass throughout the entirety of the auto sector right now, particularly hitting a lot of their suppliers pretty hard right now as well. So an interesting story, an ever-evolving one. We've been tracking a lot of the activity that's been going on out there of late on the Options Insider too, so you can, of course, surf on over to the website to get a little bit more insight into that. And speaking of options activity, it's time for us to keep on rolling right on into my own personal favorite segment, Don't Tell Uncle Mike, because it is time for the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
Everybody, welcome back to the old Odd Block, the portion of the program where we break down some of the weirder, the wilder, and sometimes the more head-scratching paper we're seeing lighten up the old options market today. Going to kick it off with a name we haven't talked about in a little while, even though they were big favorites of ours earlier this year when that whole the Dish AT&T thing was going back and forth. We are, of course, revisiting good old Dish Network, ticker symbol Dish. DISH, closing today just a tick under $60, $59.94, so off about 80 odd cents or about 1% on the day. This is the name that's been averaging about 3,200 contracts of late, so it hasn't really been lighting it up too much. Today doing a fair amount more than that, over 7,000 contracts going up today, including a decent amount, about 4,000 of those, if not some more here. I don't have the final numbers, having gone up in this one pretty sizable risk, at least for Dish, risk reversal. It was in particular out here in Nove, the Nove double, aka 55, 65 bullish risk reversal. Looks like paper sell and put, buy and call 2,000 times. Going up in two blocks over there on the Philly for a nickel debit, so they ended up paying a nickel for this. Again, it went up, looks like paper buy and call and sell and put, so legging into one of my favorite personal strategy, which is, of course, indeed the bullish risk reversal. Interesting one here, again, perhaps specking on some interesting upside going up here in Dish in the near future. Didn't see any stock or anything else going up with this one. Looking at a chart of good old Dish over the past few months. Like I said, this name was pretty volatile earlier in the year. Hit a high of nearly 80 back in December of last year and flirted with it several times throughout the year, back in February and indeed in June, getting June a little bit lower in the low 70s, but still flirted with much higher levels. Like I said, now south of the 60 handle. Our friend here clearly feeling that perhaps better days are in the future here for Dish, and loading up with some size on this risk reversal. Mr. Sebastian, kick us off here in the Odd Block. What's your take on our friends putting up some decent size in this bullish risk reversal here in Dish?
Well, now that the DirecTV AT&T deal went through, the next logical step is that somebody takes out Dish.
I'm sorry, I said Dish before. I meant DirecTV. That's what I meant.
Oh, Well, that deal's a done deal at this point. So the only question is, do they think they're going to be 18? Or, this seems to be some sort of play really on 18. Somebody that thinks that the two are going to synergize really well and wants to play for AT&T, the DirecTV combo, to have a real benefit to the underlying stock AT&T. That's really the best, really the only way that some would be executing that, because DirecTV is now a part of AT&T.
All right, thank you for that, Mr. Greasy Meatballs. We move on to our next name, our next victim, our next whatever you want to call them here when they come on the old odd block. Write in, listeners. Let us know what you think we should call them. Is it a boon? Is it a bane to be featured on the odd block? I don't know. A little bit of both sometimes. As we move on to our next name, we talked about this one before. You probably are familiar with it. This is Horizon Pharma, ticker symbol HZNP. This one is going to our bio, our pharma name for the day. Not our cheapy bio, though. It's not a sub $10 or even a sub $5. It's a comparatively rich, nearly $24 name. Of course, it was a little bit richer this morning. This name closing about $23.78, off nearly $2, or about 7.5% on the day. So not the best day for good old HZNP. This is a name that's been averaging about 5,600 contracts a day, doing a fair lot more than that. Today, over 11,000 caught our eye just in this one trade. In particular, it was the old Nove, the month of du jour today on the old odd block. 11,000 of the Nove 26 calls going up for $2.05. As it went up, we also saw, looks like a block of about 500,000 shares going up for $23.19. So indeed, a substantially lower level there. On the old stock, looks like the way it broke down, probably a buy on the calls, and indeed then, of course, a sell on the old stock. Good old delta neutral trade. Either way, looking for a lot of bang for his buck coming forward here in HZNP. A lot of vol to make this trade look decent. Again, he's got a little bit of time for this to play off. And looking back here at the chart of good old HZNP, this one has been moving a fair bit over the past 6 months, flirting with nearly as high as $40 back in July. About 38.5 or so is where it got to about on the old upside, and of course now substantially lower than that, nearly half the price there at this point. So our friend here, clearly like our other earlier friend there in good old Dish, saying perhaps the future is bright here for Horizon, or at the very least, future from a vol perspective. Very bright, I should say, in the near future. For HZNP, Mr. Greasy Meatball, what's your take on our friend here? Putting up some delta neutral upside love here in HZNP.
Well, when you see trades like this go up, especially when the market's been really volatile, it's people making a play on a bounce. And doing it delta neutral, maybe he's making a small bet that the underlying may recover, move the other way, or he's just trying to, readjust the stock position. For all we know, he could be heavily short and just using these calls to make sure that he keeps his winner. But on its surface, it looks like a trade where the guy's planning on this sucker moving. I'll tell you that much. And again, you do tend to see this stuff when you kind of see the whole market dump. You'll see some of the quality names start to get some upside action as people look to cherry pick, but choose not to buy the stock, which is the smart way to do that type of stuff.
Yes, indeed. Our friend here again, perhaps not as it appears, but indeed looking for some vol. He wants this sucker to go here, to the old analogy. If you can't stay here, you got to go somewhere. When they close the old bar, that's what he's looking for here in good old HZNP, Horizon Pharma. I'm sure we'll be checking in on this one again sometime in the near future. But staying in a relatively similar area, we're going to finish up here in the old odd block with a name. We haven't talked about this one in a while. This is Merck, of course, MRK being the ticker symbol. Indeed, of course, the massive global healthcare conglomerate, trading today about $50.60, off about 40 odd cents, or nearly about 1% or so on the day. This is a name that does a pretty decent paper, about nearly 20,000 contracts a day. And the numbers I put up today were, again, a wee bit more than that. The lion's share coming in what looks like pretty much an at-the-money put roll here on a bit of shall we say, a funky ratio, to use the technical term. We saw what looked like the OC9 weekly 47.50, 53 put spreads going up for a net of $1. Get ready for this one, listeners. 12,846 times on the 47 puts, by 25,692 times on the 50 puts, by 12,846 times on the old 53 puts. Again, doing that net for $1. There is some size open interest on the 50s and 53s. Again, that's why we think it's a bit of a roll down. Literally zero open interest on the 47s. Hence, again, why it looks like a bit of an adjustment. 53 puts, again, looking like a sell to close, and then buying in that put spread to lock it in. So interesting and sizable roll here with some fun ratios. Mr. Sebastian, take us home here on the old odd block with this funkalicious put close roll here in Merck.
Well, it's just somebody, again, repositioning. A lot of people think, oh, look at that. That's really unusual. That's really unusual. Over half of these trades end up just being someone repositioning their position. They initiated, could be months ago, could be years ago, for all we know. And, so it's probably somebody that has a real serious connection to the stock that's just making sure that they maintain that connection and don't lose their shirt in the process.
Even you and your diehard cynical heart must admit that these ratios are kind of funkalicious.
They're weird. They are indeed weird.
That's all we're looking for.
But somebody's got an axe to grind somewhere.
Clearly.
That's it. We just don't know where his axe is.
Hence the odd block. Maybe we should retitle it the Funkalicious block. I'd be okay with that. So perhaps we'll have a new transition coming soon. The Funkalicious block. All right. But unfortunately, we'll have to leave it there with that Funkalicious and sizable roll adjustment, call it what you will here, in good old Merck. A little bit different from our usual forays into recently. It's been kind of all petroleum and some stops into tech. Mixing it up a little bit today, doing kind of a double down on the old biotech / pharma and mixing in a wee bit of dish as well. So interesting stuff. We try to keep it exciting and indeed funkalicious for you listeners. And speaking of all that funk, it's time for perhaps the funkiest part of our program, because it's time for the strategy block.
It's time to dispense options, wit, wisdom, and education. It's time for the strategy block.
All right, listeners, when you think funk, you think Uncle Mike Tosaw. And it is indeed that time. I know we confused some of you by switching it up again this week. Usually we do strategery on Monday and then your mail on Thursday. Mixed it up a little bit this week because of all the craziness going on earlier this week on Monday. Of course, the great Skype outage that crippled much of the internet, causing some complications. But we're back in action for you today with some more strategery, some more wit, some more wisdom, and indeed a heavy dose of funk. Uncle Mike Tosaw, are you ready to bring the funk, sir?
Well, right now, all of our audience is screaming, "We want the funk."
Yes,
and ladies and gentlemen, I am going to bring the funk today.
Oh, now I'm intrigued.
All right. So what I want to talk today about is rolling options on verticals and or single leg puts. But I want to kind of preface this first with a re-education or an emphasis on risk shifting. So let me explain something. There's no such thing as a higher risk or a lower risk trade when you break it down in option trading. Here's what I mean by that. You can say that, let's just do a basis of comparison. Long stock, meaning you just buy 100 shares of stock, versus buying that same 100 shares of stock and also buying a put. Now, with that being said, you have, on the one hand, you have the long stock, and on the other hand, you have the protective put on the long stock. Now, which would you say is more or less risky? Well, initially, I would definitely think that having the long put is much less risky. You have the insurance on it. Well, I don't think it's wise as an option trader to view it that way, and here's why. What you have done when you buy a protective put on stock, yes, you do have less monetary risk. However, you're increasing your theta risk, your time decay risk. Should the stock stay the same, then you're obviously better off just owning the stock. Should the stock go higher, you're obviously better off just owning the stock. However, should the stock go down significantly, then you're better off having the protective put. So whenever you do any type of an option trade, there's no such thing as it being a better or a worse trade in terms of risk. Where it comes in is that which type of risk do you prefer? Now let's look at another example. Let's say that I want to buy an out-of-the-money option versus an at-the-money option. Well, of course, the out-of-the-money option, the odds are much worse at making money for you, but it costs less money. So there's always a trade out no matter what you do in trading. What you need to do as a trader is, number one, get educated from someone like Mark in terms of determining which type of risk makes the most sense for the right situation. Meaning, I don't think it makes sense to buy a lot of penny options. Today, we're recording on a Thursday. I don't think it makes sense to buy a lot of penny options right at the close in the hopes that the market's going to move a lot tomorrow and those pennies are going to turn into dollars the next day. I don't know if that's really a good move unless you really know something or and you're insider trading and being illegal, which I know none of our listeners would ever be. But with that being said, I think that it's important that you have an understanding of what type of risk makes the most sense for the situation with which you are currently faced as a trader. Whether you're flat, whether you're long and you're making an adjustment, whether you're short or you're making an adjustment, whatever the case may be. Now, what I want to talk about today is how I shifted risk in a real trade with real money. Right now, we're negative on the year in the S&P 500. So because of that, as I've mentioned on this show many times, I'm trading with much less deltas than I normally would if we were positive on the year. That's a trading rule with which I have with my SPY long call strategy. So in my SPY long call strategy, I have no SPY long calls right now, and I haven't for quite some time now. So with that being said, for the time being, I'm either totally flat or selling a pretty far out of the money put spread in some way, shape, or form. Now, going into today, I was in the September 25th expiration 190, 185 put spread. And the market came down a bunch today. And so as the market was coming down, the put spread actually got very close to a point to where one of my personal rules that I like to get out of trades whenever I'm in a vertical spread. We initially took in a credit of 52 cents on that specific spread. And so one of my rules is that I like to get out of a spread when I'm about to lose the amount with which I was about to gain. So in other words, when that specific spread, we took in 52 cents, technically I want to be out of it when it's at $1.04 debit instead of, and when it costs me $1.04 to get out of it, just because of the fact that if you wait until it gets to a debit of $3, it's going to take you an awful long time to make that money back. So I try and manage risk along those lines to where I try and not lose more than what I'm trying to gain. And that's when I make an adjustment. So we got to that point today. I got out of that 190, 185 put spread at 98 cents. Nothing's ever perfect, so I guess I technically got out a little bit too soon, but I think I got a good fill on it, quite honestly. And then I rolled down to next week's 187, 182 put spread for October 2nd expiration. And by doing that, I'm no better or worse off, technically speaking. I did kind of an oversimplified example at the beginning of the strategy block, but this is just another example of where I still have as much risk on the table and that it's a $5 difference between spreads. The only difference is that I've shifted it. Now, here's what I've benefited from it. I have another 30 points of S&P cushion, so to speak, between here and the 187 put of next week. I rolled it for a debit of approximately 11 cents. Or no, I'm sorry. I rolled it for a debit of approximately 8 cents. Now I'm looking at it. So it did cost me money to get that cushion. However, I manage the risk on it, folks. And naturally, of course, when you do that, the market always goes straight up. And that's just kind of Murphy's Law and how it works. But I'm going to live to trade another day. And if we just stay the same between today and tomorrow, I'll be profitable for this week on a week doing all bullish strategies. Won't be profitable by much, but assuming the time decay goes the way I think it'll go tomorrow, I'll be profitable in a week doing all bullish strategies when the market actually went down on the week. So is it perfect? Absolutely not. But perfectionist traders typically get blown out within 3 months anyway. So that's just the way with which it works. So what I want to explain to you is knowing the right time to shift risk. Today, I had to shift risk because of the fact that we were coming a little bit too close to my short strike price and my vertical, as well as we were actually at a stage to where I had lost as much as I was trying to gain. Now, we were sinking fast, and I did not want to be sticking around to see if we were going to be at 180, 188 by late in the afternoon, because I did not want to be down $2.35 on a trade with which I was only trying to make 50 cents on. In reality, I probably would have gotten out when I had a 40-cent profit, is what I typically do on such a trade. So I would encourage everybody in the audience to, number one, have a very deep, not just a shallow, but a deep, funk dubious understanding of how you're shifting risk. And the second thing I would encourage you to do is that when trades go against you, don't take the drug of hopium, especially if you're trading vertical spreads in any way, shape, or form. If you're an iron condor person, if you're doing vertical call spreads, vertical put spreads, and you're short the spread, definitely do not be shy about getting out of them before they go in the money. Folks, I've been in this business for well over 10 years now, and I've seen way too many people that it starts getting a little bit too close to their spread, and then they think, well, it'll come back. It's come down this far. Sure, it'll come back. Well, if you do nothing and it continues to go against you, then you're going to lose about 8 months worth of profit in one fall swoop. Whereas today, I lost a couple days worth of profit, and I'll likely get that profit back tomorrow. So if you're a little bit more active and doing something that a very good friend of mine always says, you're doing stuff, that's how you live to be a real legitimate trader, and not someone who just makes 100% in 3 months and sells a bunch of seminars and then you never hear from them again because they blew out their accounts and people are suing them because it doesn't work in month 4. And that is the functified, funk dubious strategy block for today.
Funk dubious. I like that. I might have to add funkalicious to that, but yeah, funk dubious, functified, it all applies, sir. When you're talking about risk management, there's nothing more funky than that, sir. All right. Well done, Uncle Mike. As always, we got a little bit of time, so maybe we can squeeze in one or two of you guys over there for a little bit of some listener mail.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody, welcome to the Mail Block. You guys know the drill by now. Hit us up, twitter.com/options, facebook.com/theoptionsinsider, questions at theoptionsinsider.com, stocktwits.com/optionsinsider, or just go to our website and use the myriad different contact options there to reach out to us so you can make your voices heard just like your fellow listeners. Here, can kick things off with frequent writer, inner questioner, asker, call him what you will, Fred. I believe he actually is the proud owner of some of our rare Options Insider gear, for being one of our favorite and most frequent question askers in a variety of mediums on the site and different chat rooms all over the place. He sent one in the other day that was kind of interesting. I thought it would be worth discussing on the show because we have a diversity of opinions here on the program. Mark and I having, of course, been coming from the market-making world, and Tosaw, who was unsullied from that perspective, so we get a diversity of opinion here. He writes, hey, being a market maker on the floor was a good way to learn options trading. Can you explain how market making worked and why it was the best way to learn about options trading? This is a point I've hit many times on this show and others in the past too, is that it seemed like market making, particularly back when that was a viable business a decade or so ago, or a little longer, was really one of the best ways Tosaw's making some unseemly comments, funkalicious comments in the background, listeners. Good thing you guys can't see them. But yes, it was indeed a good way. I often compare it to kind of immersion therapy for learning a language, where you kind of just dropped into Italy. You have to kind of sink or swim. If you want to go to the bathroom, eat, you have to learn Italian. Same way with market making. You were kind of thrust into that environment, particularly when the floor was an active and vibrant place, and you had to kind of sink or swim. And often you had firms invested a lot of time in you, a year or so, to get you up to speed with training programs and things, and eventually you would come on to a badge. And the nice thing about that process, the nice thing about the way market making worked in general, what made it why it's such a great way to learn options trading, was that the way the process worked is you went in there and you made, as the name implies, you made markets on every strike, every option in your products. So you were essentially you had no idea when you went in the morning. You typically had no axe to grind. Typically you traded delta neutral, which is the way we discuss here. So you didn't have a lot of directional bias, and you typically went in and you didn't know what you're going to get that day. Customers would just give you the other sides of their positions, and it was your job to take them and then spread out of them and hopefully not blow up in the process. And so there's no greater way to learn than having positions just thrust upon you. Again, going back to the immersion definition kind of learning a language, is that these things were thrown at you all day long and you kind of sank or you swam. And so it was a great way, because after a while you learned this is how these things actually perform in the real world. This is not the textbook definition. This is how skew really works. This is how all these things really work in the real world. And it was a fantastic, if indeed terrifying and stressful and life-shortening way to learn options. It was not a healthy lifestyle, listeners, but it was indeed a fun way. Of course, that route is now closed to most people, which is one of the reasons why we like to say when you're learning about options, you probably want to go to someone who may have a background in that. Hence our inclusion of the greasy meatball and occasionally the rock lobster on this program. Mr. Sebastian, having been sullied as well by the market-making path yourself, what do you have to say to our friend here and all the others who write in want to know why market-making was such a great way to learn about options?
Well, I mean, yeah, I think you hit that nail on the head. It's immersion, and the other piece is they force you to do it right. One of the things, Andrew or Mike brought up these, like some educator that, teaches you something, and then you blow out in 3 months. Most of the time when you were learning, you were trading with somebody else's money. And so it was very important to them that you learned the right way so that you did not blow out their money, not just yours. And so these people who cared about their own money taught market makers how to trade in a safe, predictable, smart way. How to spread, how to manage risk, how to manage deltas so that you don't blow out. And I think that's one of the major differences between, guys who really did it and then a lot of these pretenders that haven't really gone through full market cycles and haven't been taught to truly understand options inside and out. Market making is much more attuned to being a pilot than it is to being what would I say? Being some sort of recreational Cessna pilot. It's like being an airline pilot, because before they ever let you get behind their dollars, you would go through extensive classroom training and then simulators and things like that really most non-professionals, non-market makers don't ever have to do. And so when we say that, we've gone through everything and we really have been battle tested and time tested before we're ever really put in a situation to where we can fail, that's kind of what I think is the big difference. And so it's the fact that the amount of rigor that's applied to our training relative to everybody else as well.
And Mr. Tosaw, as the resident unsullied amongst us here, who wasn't thrust into the maelstrom of options market making, what do you have to say here for our friend, Mr. Fred?
Well, I think when you're looking for an educator, I think it is important to have something like that on your resume, that you have traded on the floor, that you've been a market maker, and that you've been educated. I'm one of the rare birds out there that actually trades as many options as I do and never traded on the floor. I was very blessed in my past life to where I was thrust upon the education world, and I got to be mentored by a lot of very good traders and a lot of people who have been market makers. And my battle testing has been well, like I've said before, over 10 years with real money and real accounts. And I kind of came onto the scene after the market making world was kind of ending. And I actually considered getting into it at some point, but it just didn't seem like it was going to continue to exist for much longer. Hence the reason I never bothered doing it. And got my education in other areas, in a lot of ways, real world 101. But I think that when you do trade and you've actually survived and have been around for more than a couple of years, it's something to be said for that. But what you guys went through back in the day in the market making world, you make a great point. You're taught by people to trade their money. They're not going to put you out on the floor for the purpose of you to blow out and sell seminars. They're looking to teach you to make actual real money.
And it is kind of a shame, that way of life has gone away for a variety of reasons we've been on before. And one of the sad things about it now is even a lot of the guys who were market makers, most of them wouldn't qualify themselves or describe them as that anymore. Most of them have become prop traders, which is, as everyone knows, a very, very different beast, a very, very different game. Doesn't teach you the same way a market making does, where you're just taking on positions. Prop traders, you're putting on what you want, and that's a different skill set. Of course, there's management involved and everything else like that. But learning by having these positions thrust upon you all the time, there's really nothing else like it. And as terrifying, as intimidating as it may be, it's also deeply, deeply educational. So yeah, good question, Fred. I'd say you get a shirt, but you already have one. So we don't want you to be to hogging all the shirts here on the network. Other people need to get some too. Meanwhile, it's time for us to keep on rolling right on into our final segment. It's time for Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, listeners, welcome to Around the Block. This is indeed the portion of the show where we break down what we're watching for the rest of this week. And of course, we all touched on Miss Yellen a lot at the top of the show. I won't deign her with any more time on the program today. I'm sure all of you, if you're like me, have kind of had your fill of her for the near future. There are some other things on the calendar, though. We are starting to get into that realm of earnings in the near future. Coming up again, we're still winding down the major stuff, but there are a few names that you may have heard of coming out this week. Nike and BlackBerry being chief among them. In fact, I believe Nike is actually coming out as we speak, so I'll have to check into that one. Perhaps we can pull it up for the end of the show. But there are some names, indeed, AAA names you may have heard of that may indeed be worth your time out there, and things to look at and focus on aside from Miss Yellen and her premium out there in the old Bix Cash. Uncle Mike Tosaw, aside from that and perhaps some earnings, what else is catching your eye? What else are you watching for the rest of this week into the weekend?
I think earnings are going to be the next story, and I'm hoping that the Fed kind of takes a sidestep from the news, and we can focus on earnings and things that really move stocks, which is individual commerce as opposed to government policy. So that is my hope on it, and also looking to see if we can hold the 1900 mark on the S&P. Tomorrow is going to be an interesting day, to say the least.
And Mr. Sebastian, what's catching your eye for this week into the weekend?
Yeah, I think it's going to be another... it's going to be all Yellen all the time and having all sorts of fun with our girl Janet Yellen, which should be interesting.
Interesting indeed. Looks like Nike's numbers are out, and they are indeed pretty good. Stock rallying a little bit on the after hours here. Closed at about 115, a little bit north of that here. I don't have the exact level. I can have a chance to pull it up before the show, but you can always check it yourself, listeners, when the show comes out, because that's all the time we have for the Around the Block segment. Also all the time we have for this episode of the Old Option Block. But before we go, as always, let's check back in really quickly with our cohorts here, our partners in crime on the old all-star panel, starting with you, Mr. Greasy Meatball. What's coming down the pike in the land of the pit over there with the pit crew?
Well, we've got the Option Pit Boot Camp starting next Wednesday. Go to optionpit.com/boot camp. Use code 25_off, off being in all caps, and you can save an extra $25. Go to optionpit.com/boot camp.
Tosaw and I were talking before the show, Mark, and we decided you and Andrew need to get shirts that say Pit Crew on them for all of your events.
Oh, is that? I like that.
There you go.
That's not a bad idea.
Some free branding from us ahead of the show here. Your invoice is in the mail. Uncle Mike, same question for you. Branding aside, what's coming down the pike in the land of RCM?
Hey, we are taking new wealth management clients. So if you are interested in doing some investing, having someone else manage your money in some way, shape, or form, maybe not necessarily all of it, but definitely a portion of it, feel free to give me a call. If you have as little as a couple $100 a month and you're looking to invest, I am at 312-212-3531, or feel free to send me an email at mtosaw@rcmfs.com.
He's just being humble, listeners. Give him all of your assets, 100% allocated to Uncle Mike Tosaw, mtosaw@rcmfs.com. I'm sure I probably just got him in trouble with some regulators, so I am indeed joking. But hit him up over there, listeners, and let him work those puts so you can sleep at night. What better alternative is there than that? And on behalf of Uncle Mike, we call him Mr. 100% Uncle Mike, and part of the pit crew, Mr. Greasy Meatball, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course, for sending in such great questions. Keep them coming, and we'll see you next time right here on the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.